Welcome to episode 17 of our sneak peek for the week. And once again, we've got some big earnings coming out this week. So make sure you're prepared. Make sure you know if it's something that you own in your portfolio and how it can affect you. I'm going to go over that list of earnings in a second here and kind of keep it right to the details. But before I do, I think this is a great call out. So far, about 8% of the S&P 500 have reported earnings. And of that 8%, 85% have topped earnings. Think about this for a second. 85% of companies that have reported so far of the S&P 500, of the 8% of that S&P 500, have topped their earnings. That's significant for so many reasons from a macroeconomic perspective. It's significant because of the way it gives us a trend of what's happening in the overall economy. It's important because it helps us to see that recovery seems to be happening, even if it's a little bit hard to see in our day-to-day. And I think that that's an important takeaway here is that, as more earnings are coming through the pipeline, big things are happening in the market. Excuse me. So I'm not going to waste time. I'm going to jump right into what's coming down the pipe here because I think, to put it another way, it's going to be a busy week. So there's a lot of big name companies in here. I know I own a lot of these in my portfolio. I would guess that you probably do as well. And if you own index funds or other mutual funds or ETFs, you probably have a lot of these companies buried in there as well. So it's worth paying attention and making sure you're checking these. So real quick, I'm just going to go through the list of what's coming down from an earnings perspective, and then we'll talk about some of the more macro US-based reporting we're expecting this week as well. And then I just want to give some thoughts on Netflix because I think that's a big one we're expecting. I think a little bit of context with Netflix and the way things are rolling there is important to understand from my perspective. And again, it's just my take on it, but I think it's something to sort of develop your own point of view on as well. So Monday, we know that AutoNation, symbol AN, is going to be reporting before the market opens. And then a big one is going to be IBM, symbol is IBM. There's going to be coming out after the market closes. So that's on Monday. On Tuesday, Synchrony Financial, SYF, Philip Morris International, PM, Halliburton, HAL, Ally Financial, ALLY, are all going to be reporting before the market opens. So again, that's Tuesday before the market opens. Netflix, NFLX, Chipotle Mexican Grill, CMG, and United Airlines, UAL, are all going to report after the market closes. So already, these are some pretty big names coming down the pipe, so it's worth being aware. On Wednesday, we're looking at Anthem, ANTM, Johnson & Johnson, J&J, the General NASDAQ, NDAQ, Coca-Cola, which is KO, Harley-Davidson, which is HOG, HOG, Verizon is VZ, and those are all going to be reporting before the market opens. Again, a lot of big names here, and that's on Wednesday. Now, Wednesday after the market closes, we're looking at Las Vegas Sands, LVS, Whirlpool, WHR, and Texas Instruments, TXN, as well as Equifax, EFX. Those are on Monday afternoon after the market closes. On Thursday, we're continuing with a really, really big day. This is the one, write these down because these are representative of a lot of portfolios out there. Danaher, DHR, DR Horton, DHI, AT&T, which is just T, Newmont Corp, NEM, Dow Inc., DOW, Abbott Laboratories, ABT, Alaska Air Group, ALK, Biogen, BIIB, American Airlines, AAL, Domino's Pizza, DPZ, the Blackstone Group, BX, Crocs, CROX, Southwest Airlines, LUV, Union Pacific, UNP, Capital One Financial, COF, Intel Corporation, INTC, Boston Bear Company, SAM, as in Sam, Twitter, TWTR, and Snap, which is Snap, are all reporting on Thursday. And then finally on Friday, we have American Express, which is AXP, Schlumberger, which is SLB, Honeywell, HON, and Kimberly-Clark, KMB, all before the market opens. So if you're listening to this and you're like, wow, man, he's just putting a ton of stuff out there. Yeah, I am. And yeah, it's important. These are major U.S. corporations that are going to be coming out with their earnings this week, spread out fairly well throughout the week. Obviously, we're sort of middle loaded here with Tuesday, Wednesday, and Thursday representing the huge sort of basket of earnings. But what's going to be particularly interesting this week when you think about these earnings is this is really a true spectrum of the entire marketplace, right? From corporate software and technology like IBM to streaming services like Netflix, to the airlines, right? As well as things like DR Horton's and Domino's. And then, of course, some of these big ones in here, like the Biogen and Abbott Laboratories. Coca-Cola's in here. We're gonna see Harley Davidson. How many people are buying motorcycles? Verizon obviously is representative of a lot. This is a particularly interesting week, especially if you're new at understanding how markets work and how the market structure is going to affect you and your portfolio. Seeing the way that they report, but more than just that, what I really want to urge is listen to the earnings calls. They're recorded, so you don't have to listen to them live. You can listen live, by the way, which is a great experience if you haven't done it, and I strongly urge you to do so. But certainly, at a minimum, pick a few of these and listen to the earnings calls. Listen to the kinds of questions that get asked. If there's a presentation or some slides that are shared, get them. Get feel for what they're reporting and saying is happening. But also, more than any of that, I think it's really important, especially for those who are coming in higher than expected. What do they see? Is it a one-time thing? Do they expect it to continue? Are they seeing growth that looks like it's accelerating? Is it trending towards a flat line? This is really layer one of analyzing your investments, is understanding how companies are performing, what their leadership is saying about that performance and the directionality that they believe it's going to go in. And really, frankly, if you own any sort of major funds, you're probably representing quite a few of these names in there, whether you know that or not. So definitely take the time to look at it. And even beyond that, for the sake of just understanding what's happening in the markets, it's worthwhile to pick a few of the bigger names on here that maybe are targets that you were thinking about investing in or just are simply interested in. Like Coca-Cola, it's very indicative of how people are spending their money when they're going shopping, right? Is it more towards the traditional products or some of the more alternative products they've come out with over the years? I think I'm looking at like Blackstone Group as an example to understand what kind of PE activity is going on out there. I know they're busy. I know right now the M&A space is going wild. We're seeing it like absolute hotcakes in the mid-market and commercial sectors, where everyone is seemingly being bought, acquired, put under P&E management. We're seeing M&A activity across the board. That for me is one I'm definitely going to be watching and listening to. And let's take pause for a second on Netflix, because I think Netflix is a really interesting one as well, where what I keep thinking to myself is, are we at a point where we're hitting like key saturation levels for Netflix, right? At this point in time, practically everyone I know has a Netflix subscription. I understand that may not be representative of a global perspective, but certainly if I think about all the houses on my street, I'm pretty confident every single one of them has a Netflix subscription. So I'm starting to get that feel of how much longer can they have this exponential growth? Is it going to continue? Are we going to see some steadying off of that? Are they planning to do something to change that? Might be new content, might be new approaches to the market, maybe they have different deals. Whatever the case is, I don't have an answer to it. But I know for sure there has to be a point where saturation is going to be important. And for sure, I want to understand what that means and what that looks like, because I think that is sort of a ripple effect of, will that mean that there's saturation across the other markets? Or is this meaning like Disney's going to jump in, Discovery, et cetera? Are they going to have more opportunities to sell us streaming services? Which frankly actually raises a better point. As we're looking at the way the economy is apparently slamming pretty strong based on that FactSet data right from the beginning of our call here, at what point can we keep adding incremental costs to our monthly bills, right? Whether it's a Netflix subscription or a new car. Hey, debt-free dad jumping in, man. Good to see you. Thanks for jumping in. We're talking about earnings for the week coming up. It's a huge week. And by the way, debt-free dad's crushing his goals. I was just watching a couple of his videos earlier today. You should definitely check it out. I think what we're seeing is this almost great time actually for that comment to hit, because what I'm really talking about is this concurrence of all the streaming services, all the additional spend. The economy is booming. We know there's a lot of inflation in there, but at what point are these incremental monthly costs just becoming overbearing? You're leasing a car, you've got 5 streaming services, you've got streaming services in your vehicles, you've got them in every room in your house. People are eating out like crazy more than ever. We're starting to travel again. But what we're not seeing is wage growth. So as we're looking at the earnings of all these companies and we're looking at these great results we're seeing across the S&P 500, what we're not seeing is the sustainability, at least from my purview. So again, know what's happening. Know not just if they're beating their estimates, but how they're beating them, because how they beat them is extremely important. And I think it's a big piece of the pie to understand, are they beating their analyst calls because it was a one-time huge event and that's why they won. And now their CEO or CFO is saying, we may see dwindling results the rest of the year. You have to know that kind of information. But the beauty of it is, It's going to be force fed right over the phone. They're going to explain what's happening. Analysts will ask questions. And again, I'm stressing this because it's important. Listening to analyst calls or earnings calls is a really important experience on your investing journey to understand the way an analyst thinks about the questions they're asking, right? If you're investing in software companies, do you understand ARR versus MRR? Do you understand what kind of attrition rates they have on the cost to acquire new customers? Can you explain their TAM when they go to market? If you can't, those are great questions. They'll actually get answered for you in the investor presentation during an earnings call. Those are questions analysts will ask on your behalf. So again, great experience. Try to dial in or listen to the recordings when you can. Really, it's worth your time. So let's jump gears a little bit too and start talking about some of our more macroeconomic data that's going to be coming out this week. Again, this is sort of a long list, and if you take one thing away from me reading this out loud, it's just to start to get the feel of really understanding that there's always something going on. There's always some kind of news or reporting or numbers coming out, and the more you can understand the correlation between these different earnings events from a macro perspective or an economic perspective, and how they tie into the way the markets move, individual stocks move, or funds move, the more you can really build a safety net to understand what happens when bad data comes out on this particular earnings piece. Well, these things happen over here. That's where you start to build that strength of portfolio, that hedging, that correlation between the way different things move. And if you're new to understanding what that means, I'm going to explain it in pretty simple terms. When we think about correlation between two stocks, bonds, funds, economic indicators, whatever the case might be, what we're trying to understand is when A goes up, does B go up or does it go down? Does it stay in the middle? The way they move as news comes out is the way we understand correlation or variable correlation between the two. This is really when you get into some fun stuff. You get to look at how stocks move together. It's really easy to see this on a chart. And again, we're serious investors. We're making serious financial decisions. We want to be empowered. We want to be educated. And that's the value of knowing how all this works. So with that, let's jump into what's coming down from an economic indicator perspective next week. So tomorrow on Monday, the NAHB housing market index is going to be coming out. We're expecting a number of 82. We had 81 in June. Excuse me. On Tuesday, housing starts month on month. We're going to see June. We're expecting a plus 1.2% when we actually had a plus 3.6% in May. We're going to be looking at building permits month on month. That's all going to be on Tuesday. On Wednesday, we're looking at the MBA mortgage applications for the week ending July 16th. We know they were plus 16% in the prior week. So look, let's call a spade a spade. The housing market is on absolute fire, or certainly has been. I think what I'm looking to understand is with lumber prices finally coming down and maybe not being back to normal, but certainly not where they were. What I'm trying to understand is, are we still seeing building like crazy? Was it a supply chain issue? Have we solved for that supply chain issue long term? Are we seeing mortgage applications continuing to rise, which means increased demand on housing prices? And then just general housing competitiveness, what's out there in the market. So these are the things I'm going to be listening for, and I really would suggest that you find a couple of indicators you're interested in and learn how it sort of affects your portfolio or the general way the market moves as well. On Thursday, we have the Chicago Federal Reserve National Activity Index, as well as initial jobless claims for the week ending July 15th, always a big one. We have continuing claims for the week ended July 10th. We have the leading index for June, where it's a 0.9% expected. We had a 1.3% in May. We're also going to be looking at existing home sales. For June, we're expecting 5.9 million, and we had 5.8 million in May. We're also going to have the Kansas City Federal Reserve Manufacturing Activity Index for July. Again, you're getting the feel here. It's about housing. It's about unemployment. It's about manufacturing. These are really important numbers that really help to hold up our economy. If these numbers stay strong, potentially we're going to be good in the market. If we start to see a lot of weakness across sort of jobless claims, continuing claims, home sales, etc., I start to get nervous and start to think about where I need to protect myself. Now, on Friday, we have the market, that's MARKIT, U.S. Manufacturing PMI coming out. Market, same thing, MARKIT, U.S. Services PMI for July. And we also have the market U.S. Composite PMI for July as well. So there's a lot going on in the week coming out. And all these things really bear repeating that these are things, we talked about this last Sunday. These are things that are very easy to throw into an Excel spreadsheet and start to look at how the numbers are moving across a time period. Understanding what was expected versus what happened. Was it positive or negative or neutral? Is there any sentiment behind that? Can we understand why it would have gone up or gone down? Where's an explanation? And this is how you build that knowledge. This is how you get a feel for what's going to happen, or at a minimum, starting to understand the impact of what happens if it goes the wrong way. So I think about this all the time. Um, this is going way back, many, many, many years ago when I was in the currency markets as a spot trader. Um, it was so important to understand not just directionality of the markets when news like this was coming out, but really, really important to understand what happened when it was wrong, or what happened when it was right, but really right. We really blew the numbers out. Because what happened oftentimes is you can see quick reactions, and then they reverse right away. And a lot of new traders, new investors, they think great news, jumping in. But they misunderstood some piece of detail or some small data point that maybe wasn't that obvious. And next thing you know, what looked like a vertical line is now crashing into the floor. And a lot of people lose a lot of money this way. So it's important to take all this information, track it over time, understand how it affects your portfolio, understand how they affect each other. But even more so, and this is one of the most basic things you can do, and something we probably don't even talk about enough, is always understand the back testing, right? Last time something missed, go back and take a look at a chart. Did it go up or down or sideways? What kind of a miss was it? Was it significant? Was it expected? Was it less so or more so? Just start to slowly build that knowledge base to see what's happening in the markets. Because I think too many people nowadays are very focused on very technical analysis, or a lot of times they call it TA. Other people are really focused on social media arbitrage. Other people are really focused on fundamental analysis. And I think the challenge we have as retail investors who are trying to build portfolios for ourselves and our families and build wealth is we have to have a grasp on all of those things. You do not need to be an expert in them, but have enough of a grasp of a small area that at least gives you some sort of signal or some sort of direction that you can pay attention to. And that helps you to understand what's going to happen. Or certainly at a minimum, you can start to have some degree of prediction as to what direction you think it might go. And if you're right, great. And if you're wrong, you set some sort of a stop or a loss to make sure you didn't get killed on that trade or that investment. So with that, we've got a really busy week. We're going to be looking at tons of earnings. We know the reporting thus far has been great. We know it's a really busy week continuing on the on the economic indicator front. We know lumber prices are down. We know that we're expecting a lot of blowout earnings. So know what's in your portfolio, listen to the analyst calls, understand how things move depending on what happens with the results. And short of that, what I would say is really get your arms in and around this market, because this has the feeling of being very frothy, but yet still possibly room to run. But at any time, that room can run out. So, keep your eyes on what's going on, watch the trends, understand how these trends match up with other periods of time. Like I was actually talking to a friend the other day. This is a funny story. Maybe I'll end on this. We were just commenting on up in this area, we've seen an absolute humongous amount of like Porsche SUVs. And the Cayenne and the Macan, we've been seeing tons of them, more than ever. Range Rovers, Land Rovers, we're seeing a lot of them on the roads, more than we've traditionally seen. We're also starting to see a little bit more of, and granted, maybe not brand new. Thank you very much, man. I appreciate the comment. I'm slow on the typing. That's not my specialty, but I appreciate the comment and thanks for that. What we do is we look at what I would say are maybe not leading indicators in a global sense or a macro sense, but just in my own little bubble, my own ecosystem of where I live, the way that I look at the markets. I look for trends or things that make me raise an eyebrow, right? And it's like, why suddenly are so many people driving Porsches, right? When we know home prices are exploding upwards. Well, we also see tons of construction going on, and practically every other house I drive by has a crew, or there's a sign that says, construction by, or et cetera, et cetera. And all I keep thinking is, I know that during when '07 and '08 happened, it was because of very different reasons. But the same kind of trends I was seeing, the high-end vehicles in the big brand new houses driveway with all the new construction going on, and they've got the toys and you can see the TVs. And it just starts to feel like this market exuberance of my 401k is doing great. My house is worth twice what it was 10 years ago. Things could not get any better. So I'm going to start to take money out of my home, or I'm going to have more confidence in my job that I'm not going to lose it. So I'm going to spend more of what I make. Those are purely anecdotes. And I don't believe that an anecdote is the basis of a strong portfolio or a way to invest or understand the markets. However, However, an anecdote sometimes can be a very early signal. So as I see things like, 20 Porsche SUVs drive by me a day, and Range Rovers and Land Rovers and more Mercedes and everything else, great for you if you drive one. I'm glad that you do, and I hope you love your vehicle. But I look at it and I immediately say to myself, I wonder what sales have been for Porsche. I want to go and look at whatever I can find in the market about that. I start to understand, like, what are our home prices? How are they trending and how are they going up? We were just talking about the mortgage rates will be out. I'm sorry, mortgage numbers will be out this week, coming out for the week prior. And what I'm seeing is there's like a battle to get houses. So people are paying more than ever. Then there's brand new cars in the driveway. There just seems to be a preponderance of spending and almost a fearlessness of money. And the problem is the very first blip, that crashes fast. The easiest way that I can create correlation for you if you're watching this is to think about a few months back when we saw the crypto market basically implode. There was a million different reasons why people said this happened, and it could have been this, it could have been that. But when you peel back all of the fluff and the FUD and the bullcrap, you know what it really was everybody was leveraged to the absolute bone on highly speculative assets in an asset class that has a potential to crash like that and has happened several times. Could go straight back up again, sure. But if you're highly leveraged and you get smashed on a margin call and you lose your position, you're not getting that back. So these are the same kind of feelings that I have when I look at leverage to the bone on your mortgage, leverage to the bone on new cars, leverage to the bone on the vacations and everything else that's going on. Although these might look like strong economic indicators, and sometimes they are for sure. In fact, they definitely are strong economic indicators. But they're also, for me, an early warning sign of, are people spending more than they have? How much of this is going on credit? How much is in the mortgage? How much is tied to a car payment? And on top of all of that, we're seeing the streaming services. We're seeing more and more of them coming out. It's $10 for this, $10 for that, $10 for this. Before you know it, you've got $200 a month in streaming every single month. That's a car payment right there on top of all the other things you're trying to pay for in the first place. And I think that creates a lot of stress and it creates a lot of mental health issues. I'm not for everybody, of course, but what happens is it just keeps building and building and building, and then it crashes. And it can happen really quickly. And as investors, it's our responsibility to ourselves and to our portfolios to see the risks before they happen, see the trends as they're building, see the signals, see the indicators, right? The easiest way that I think about this, and I'm going to say goodnight after this because I could talk all day on this topic because I love risk and I love risk assessment. When you are coming up to a traffic light, right, and you see that it's turning yellow, it's an indicator. A red light is coming. You have to stop. That's where we are oftentimes in the economy, and it's our job as individual investors managing our own money to understand, is the light starting to turn yellow? Are we green? Has it already red and we just missed the boat? And that's what I would challenge you to think about here. And if you happen to watch this and you like what you're hearing, I'd appreciate some feedback on it because I cover a lot of different topics. I'm not always sure what's hitting the most or not. But these fundamental analysis components are really important when you're looking at the macroeconomic trends that are happening. Double down with a little bit of TA and you're going to be in really good shape to understand what's happening. So with that, thanks so much for watching. I really, really hope you got some value out of this. My friend over at Debt Free Dad, who always comments and watches these videos, I appreciate you, man. Thanks so much for watching. If you haven't checked out that channel, you definitely should. He's a great guy and really does a lot of great content as well. And his family's hilarious too when they're on the videos. So check it out. Thanks so much for watching. Have a great week. Watch some analyst videos. Watch some earning videos. Understand what's happening. Watch the presentations. Good luck out there. I hope you're crushing it. I hope your numbers are huge. And with that, I'll see you soon. Thanks so much, everybody. Good night.